Welcome back to another episode of the e-learning series on GFSM, the Government Finance Statistics Manual. In this episode, we will be talking about government debt. I will explain the statistical definition of debt, talk about the debt instruments, and the difference between gross and net debt. Let's assume we want to compare the fiscal position of two countries. Both countries start off with the same level of debt, 55% of GDP. Now, the government in country A borrows an additional 5% of GDP to invest in its road network, which urgently needs to be improved. Its debt is increased to 60% of GDP. The government in country B borrows even more money and increases its debt to 65% of GDP. With this, it provides loans to its automotive industry. Even though the industry is in good shape, it uses these loans to invest heavily in energy-efficient cars. Looking at the debt level now, which country is better off? At first glance, it appears the country A is in a better position, given it has a lower debt to GDP ratio. But the truth is, we can't say this just yet. Debt analysis requires more than just a single figure, and there are two key debt concepts that provide insights from differing angles: gross and net debt. Let's first take a look at the statistical definition of debt and the related analytical measures. The figures we cited in our example are so-called gross debt values. They depict the value of all debt liabilities at a specific point in time. What are these debt liabilities? Debt is defined as liabilities that require the payment of interest and/or principal at one or more future dates. Let's look at the instruments that qualify for this definition. In total, there are 6 categories of debt instruments. Debt securities and loans are quantitatively the most important ones. But there are also other instruments with which governments can incur debt, such as pension liabilities for government employees or accounts payable. Please note that debt liabilities do not cover all of GFSM's liabilities. Equity and shares and financial derivatives do not qualify as debt because those instruments don't involve the payment of principal or interest. There is thus a very clear statistical definition of gross debt and its underlying instruments. And GFSM takes a comprehensive perspective with including all the respective debt liabilities. Yet currently, not all countries are equally equipped to compile a complete set of data on total debt liabilities. Some countries, for instance, only publish data on a subset of instruments, such as debt securities and loans. You thus have to pay attention to what debt instruments are actually covered if you look at debt figures. The good news is that the presentation techniques have been developed to allow for international comparison between countries that compile gross debt with a limited set of debt liability instruments. Most importantly, the GFSM framework lays out the categories to report debt liabilities on the required level of detail. Gross debt is an important measure for the assessment of the fiscal position. It shows the total amount of obligations that have to be refinanced or paid back in the future. This means other sectors have a clearly defined claim on the government. However, if you want to assess the capability for government to repay its debt, an approach would be to take financial assets into consideration. After all, government financial assets are claims on other sectors and therefore can, in principle, be used to pay off the debt. So if we add up the total value of debt liabilities on the one side and the value of financial assets in the same categories on the other, we can calculate the residual. Total debt minus financial assets, this GFS measure is called net debt. Net debt indicates what would remain if the government would liquidate those financial assets and use the funds to repay its debt. Often, there are also inherent links between debt instruments and financial assets. For instance, if you have a funded employee pension scheme, which is part of government, you will see the pension obligations as debt and the corresponding invested funds as financial assets. Looking at net debt can also help to take such links into account. Sometimes a narrower concept of net debt is used for fiscal analysis, the so-called debt net of highly liquid assets. This measure only counts very liquid financial assets, currency and deposits, and parts of debt securities. It is therefore a more prudent net debt measure. Having these different debt measures provides valuable insights into the current fiscal position as well as its sustainability. GFSM offers the concepts and guidance for an extensive set of information related to debt to support fiscal analysis and decision-making. So let's get back to our countries. With the new roads, country A acquired non-financial assets. While this investment could well be beneficial for future economic growth, there are no financial assets to be offset in the net debt measure. Country B, in contrast, acquired financial assets as it provided loans to its industry. Hence, it received a financial claim in return, and those 10% are counted in net debt, which is thus at 55% of GDP. That's lower than in country A. And net debt has provided meaningful information. After these loans matured, the government could actually pay back its own debt. So country B's gross debt, too, is back at 55%, whereas country A still owes the 60%. So how do the countries compare in the end? Well, country B has a lower gross debt in the end, a leading automotive industry, and a lot of brand new cars. However, the citizens noticed that the road network was in bad shape. So many decided to go on vacation in country A, which is famous for having lovely panoramic routes and very modern highways, a boost to the tourism industry here. You see, gross and net debt do indeed provide important information, but government also needs to use its funds wisely.